Hi, this is John Camarianos. Welcome to a new edition of Capital Considered. Today in the Wall Street Journal, the columnist James Mackintosh had what I thought was an excellent article on two funds that use the same investment factor, but somehow have wound up with different portfolios. So this is an iShares fund and an Invesco fund that pick stocks on what's called the quality factor. No one can really agree on what quality means. I think everyone thinks it's some version of return on invested capital, return on assets, return on equity, something like that. But then there's usually a balance sheet component that the company should not have too much debt. And then there are other fancier or more complicated things. And the Invesco fund uses something called the accruals ratio. And that means how much do the stated earnings of the company differ from the cash it's actually generating? And in NVIDIA's case, and perhaps some other tech companies, there's starting to emerge a discrepancy between the stated earnings and the cash. And you might wonder, well, how can that be? Well, this couldn't happen in real life, but if you could imagine this, I could go to a car dealer and say, I want to buy that car, and I'll pay you 6 months from now or 9 months from now. And the dealer lets me leave with the car off the lot that day. So the dealer books it as a sale, although the dealer hasn't received cash from me yet and may not receive cash from me until 6 or 9 months from now. And so the dealer maybe lists that as accounts receivable on the balance sheet. I owe it to the dealer. I've driven off the lot with the car. So the sale is booked, the profit is booked, but the cash hasn't arrived in the dealer's hands yet. And so the dealer lists it as accounts receivable. That's what's going on with Nvidia. If you look at the most recent balance sheet of Nvidia, you'll see about $33 billion in accounts receivable. And then if you look at one from 4 quarters ago, you'll see about $17 billion in accounts receivable. So as the receivables go up, that means more customers owe Nvidia money. Nvidia is floating more customers' money in some sense. So that has kicked Nvidia and a few other tech names out of one of these quality funds because it's deemed not to be a high quality company anymore because there's too much of a discrepancy between its earnings and the actual cash that it's generating. So it means a little bit more for the markets than just these two funds have different criteria for judging what quality means. This is really what's going on in the whole tech sector now and why people are starting to have some doubts about it. Companies like Nvidia are floating their customers money for extended periods of time. Nobody, I think, has been able to wrap their arms around how dangerous that might be, how severe it is. But that's the discussion among analysts and among investors regarding tech stocks now. So this at least informs you a little bit, I hope, about some of the discussion, some of the debate going on in the tech sector. We don't know how it will play out, how high quality these companies really are, how successful AI will be. But for now, this is John Camariano signing off for Capital Considered. Thank you for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.